A trend line is one of the most powerful tools in technical analysis, and every trader should know how to use it. But the problem is, most traders are using it the wrong way. And not only that, every trader draws it differently. For example, if you look at this chart, some traders prefer drawing the trend line through the candle wicks, whereas others ignore the wicks and use only the candle bodies. Now, let's say we've drawn the trend line correctly. The next question becomes, how do we use it to make trading decisions? Should we wait for the price to reach the trend line and enter a buy trade, expecting it to bounce higher? Or should we wait for the trend line to break and then enter a sell position? Let's be honest here. I've tested and backtested all of these methods, and over a long period of time, I found what I believe is the best trading strategy using trend lines. In this video, I'm going to share it with you, a complete, step-by-step guide on how to trade with trend lines. But before we begin, if you don't want to miss future practical trading lessons, make sure to hit the subscribe button. All right, let's continue with the lesson. First of all, what is a trend line? A trend line is simply a straight line drawn on a chart that connects multiple swing points. Okay, the first step is learning how to draw a trend line properly. Take a look at this chart. As you can see, price is constantly moving up and down. With all this noise, how can we tell what the market is really doing? It's actually very simple. We draw a trend line like this. If we draw this line so that it connects the swing points, we can see that the line is sloping upward. What does that tell us? It tells us that even though price moves up and down in the short term, the overall direction of the market is still upward. Now, let's look at the opposite case. Just like before, price is constantly moving up and down, but if we connect the swing highs, we can see that the trend line is pointing downward. This tells us that even though the market experiences short-term rallies and pullbacks, the overall trend is still bearish. At this point, you might be asking, can't we just look at the chart and tell whether the market is trending up or down? Why do we even need a trend line? And that's a fair question. The answer is simple. A trend line is not just a tool for identifying the trend. More importantly, it helps reveal trading opportunities that you might never notice otherwise. In other words, a trend line doesn't just tell you where the market is going, it helps you spot high probability setups hidden within the price action. For example, in this chart, we've drawn a trend line connecting the swing lows. If you look closely, you'll notice that every time price touched the trend line in the past, it bounced away from it. This suggests that if price approaches the trend line again in the future, there's a reasonable chance it may react in a similar way. Based on that idea, one simple strategy is to wait for price to come back near the trend line and then look for a buying opportunity. But there's a second reason why trend lines are so useful. A break of the trend line can sometimes be an early sign that the trend is changing. For example, in this chart, we connected the swing highs to draw a trend line, which showed that the market was in a downtrend. However, right here, price broke above the trend line. Shortly after that breakout, the market transitioned from a bearish trend to a bullish one. This doesn't mean that every trendline break will lead to a trend reversal, but it does tell us that market conditions may be changing. As a result, the next time we see a meaningful trendline breakout, we can start looking for potential trading opportunities in the direction of the new trend. However, it's important to remember that all of the examples we've looked at so far are idealized examples. In real market conditions, we can't enter a trade simply because price touches a trend line or breaks through it. Why? Because trend lines rarely work in isolation. If trading were that simple, everyone would be profitable. That's why we need to combine trend lines with other concepts, such as price action, to significantly increase the probability of success. In other words, a trend line should be treated as a clue, not a trading signal by itself. The real edge comes from combining trend lines with price action confirmation and proper risk management. We'll cover all of that later in the lesson. But before we can trade with trend lines, we first need to learn how to draw them correctly, because if you get this part wrong, the rest of the strategy becomes useless. The first step in drawing a trend line is identifying swing points on the chart. Swing points are areas where price moves into a level and then clearly moves away from it. When identifying swing points, focus only on the ones that are obvious and clearly visible. In other words, don't try to force swing points where they don't exist. Only use the points that genuinely stand out on the chart and can be recognized at a glance. Remember, if you have to spend several seconds debating whether something is a swing point, it's probably not a swing point worth using. Once you've found two clear swing points, drawing the trend line is easy. Just connect them with a straight line. But this brings up one of the biggest debates among traders. Should a trend line be drawn using the candle wicks, or should it be based on the candle bodies? The answer is simple. Use whichever one gives you more valid touches. For example, in this chart, if we draw the trend line using only the candle wicks, we get just 3 touches. But if we draw it like this, we can see that the number of touches increases significantly. Since our goal is to identify the trend line that has the most meaningful interactions with price, this would be the preferred way to draw it. There are two important things to keep in mind. First, not every touch has to come from the same type of candle structure. Some touches may come from candle wicks while others may come from candle bodies. A combination of both is perfectly acceptable. Second, never think of a trend line as a precise mathematical line. Instead, think of it as an area or a zone. As long as the trend line generally aligns with the swing points and captures the market structure, it remains valid. So don't become obsessed with drawing it a few pixels higher or lower. Trend lines are zones of interest, not exact price levels. Remember, the goal is not to draw the perfect line. The goal is to understand how the market is reacting around that area. Let's go through one more example to make this concept completely clear. First, we identify the major swing points on the chart, both the swing highs and the swing lows. Once we've identified them, all we need to do is connect those swing points to create our trend line. As you can see, the process is actually quite straightforward. So, to summarize, Step 1. Identify the major swing points that clearly stand out on the chart. Step 2. Draw your trend line in a way that captures the highest number of meaningful touches and reactions from price. Don't worry about making the line perfect. Focus on representing the market structure as accurately as possible. Now that you know how to draw trend lines correctly, it's time to move on to trendline trading strategies. The key idea is that we treat a trend line as an important price level, a key area where the market may react. Let's say we've drawn a trend line on this chart. As you can see, every time price touched the trend line in the past, it bounced higher. Because of that, it's reasonable to expect that if price returns to the trend line again, it may react in a similar way. However, that doesn't mean it will happen every time. No pattern works 100% of the time. For example, in this case, price returned to the trend line, but instead of immediately bouncing higher, it paused for a while and then broke below the trend line. If you had entered a buy position simply because price touched the trend line, you would have ended up with a losing trade. This is exactly why blindly buying every trend line touch is not a profitable strategy. We need a better way to separate high probability setups from low probability ones. And that's where price action comes into play. Instead of reacting to every touch, we'll learn how to wait for confirmation before entering a trade. Step 1 is to find a market where a valid trend line can be drawn. The next step is to use the stochastic oscillator. To add it in TradingView, simply search for stochastic and select the indicator. Then, open the indicator settings and set the parameters as shown on the screen. Now, here's what we're looking for. We want price to be approaching the trend line, while the stochastic oscillator is entering the oversold region. This tells us that the market may be temporarily exhausted to the downside within a larger uptrend. But remember what we discussed earlier. We treat a trend line as a zone, not as an exact line. So price doesn't need to touch the trend line perfectly. As long as the price is reacting within that trend line area, the setup remains valid. Now comes the entry trigger. We do not enter the trade simply because the stochastic reaches the oversold zone. Instead, we wait for the stochastic line to cross back up and re-enter the blue zone. So, the formula is simple. Trade with the trend, wait for price to reach the trend line zone, wait for stochastic to become oversold, and enter when it crosses back up. For risk management, we place our stop loss slightly below the most recent swing low. For the take profit level, we use a risk to reward ratio of 1 to 2. In other words, for every dollar we risk, we're aiming to make $2 in return. As you can see, price bounced from the trendline zone and eventually reached our target. Now, the most important lesson here is not the trade itself. The key takeaway is that we're using the stochastic oscillator as an additional layer of confirmation. Instead of blindly entering a trade every time price touches a trend line, we're waiting for evidence that momentum is actually shifting back in our favor. That extra confirmation helps filter out many low-quality setups and can significantly improve the probability of success over the long run. Now, let's look at another example. As you can see, we're using the stochastic oscillator with the exact same settings I showed you earlier. This time, the market is in a downtrend, and we've drawn our trend line by connecting the swing highs. Since the stochastic has already reached the overbought region, all we need to do now is wait for it to cross back down into the blue zone. That will serve as our confirmation signal. There's also another important factor working in our favor here. Notice that price has rallied into a resistance level that previously acted as support. In other words, we have multiple factors lining up at the same location: a downtrend, a trend line resistance, an overbought stochastic reading, and a previous support turned resistance level. When several independent signals point in the same direction, the setup becomes much stronger than relying on any single signal alone. Now, for risk management, we place our stop loss slightly above the most recent swing high. Then we set our take profit target at twice the size of our risk, giving us a 1-to-2 risk to reward ratio. As you can see, price rejected the area, moved lower, and eventually reached our profit target. Now let's move on to strategy number 2, which may be even more profitable than the first one. Let's assume we have a clearly defined downtrend with a valid trend line in place. Normally, when price breaks above a descending trend line, it can be an early sign that the market is transitioning from a bearish trend to a bullish one. After all, the downtrend structure has been violated. However, that doesn't mean you should immediately enter a buy position the moment the trend line breaks. And here's why. You may be dealing with something called a fake breakout. A fake breakout occurs when price briefly breaks through the trend line, convincing traders that the trend has reversed, only to reverse back in the opposite direction shortly afterward. As a result, many traders enter too early and end up taking unnecessary losses. Fortunately, there is a simple way to reduce the chances of getting trapped by these fake breakouts, and that's exactly what we're going to cover next. The first step is to draw a valid trend line. The second step is to wait for price to break through that trend line. Now, in order to determine whether the breakout is genuine or just a fake breakout, we need evidence that the downtrend is actually losing strength. One of the best ways to do that is by analyzing market structure. Take this example. Price forms a low, then breaks below it and creates a new lower low. It continues doing this over and over again, which is exactly what we expect in a downtrend. However, just before the trendline breakout occurs, something interesting happens. Price fails to create a new lower low. This is an important clue. It tells us that the bearish structure is already weakening before the breakout even takes place. In other words, sellers are no longer able to push the market to fresh lows with the same strength as before. But that's not enough on its own. We also want the breakout candle itself to close clearly above the trend line. A wick piercing through the trend line is not enough. We want a strong and obvious close above the trend line zone. Why? Because, as we discussed earlier, trend lines should be viewed as zones rather than precise lines. A strong close above the zone gives us much more confidence that price has truly broken out and is no longer trading within that area. There's one more important detail to keep in mind. The higher low must occur near the trendline breakout. In this example, there are a few earlier higher lows on the chart, but none of them were accompanied by a trendline break. As a result, they did not provide the same level of confirmation. What we're looking for is a combination of events happening together: a weakening downtrend, a higher low, and a confirmed trendline breakout. When these factors align, the probability of a successful reversal increases significantly. So, to summarize: 1. Draw a valid trend line. 2. Wait for price to break and close clearly above the trendline zone. 3. Confirm that the bearish market structure is weakening, ideally with a higher low forming near the breakout. 4. Only then do we consider a buy opportunity. Once all conditions are met, we can enter the trade. For risk management, we place our stop loss slightly below the trendline area and the recent swing low. For the take profit level, we use a fixed 1 to 2 risk to reward ratio. As you can see, price continued moving higher and eventually reached our target. This is a great example of why patience matters. Instead of buying the moment the trendline was broken, we waited for confirmation from the market structure first, and that extra confirmation helped us avoid many of the fake breakouts that trap impatient traders. Let's go through one more example to make sure this concept really sticks. In this example, we have a clear uptrend. The first step is to identify and draw a valid trend line. Once that's done, we wait for price to break below the trend line. Now, notice something important. Price is no longer creating new higher highs. This can be an early sign that the bullish trend is losing momentum. In other words, buyers are no longer able to push the market to fresh highs as easily as before. At this point, we wait for a candle to close clearly below the trendline zone. That gives us confirmation that the trendline has been broken. Since all of our conditions are now satisfied, a weakening bullish structure and a confirmed trendline break, we can consider a sell trade. As you can see, price moved lower and eventually reached our profit target. And that's it. If you found this lesson helpful, make sure to hit the subscribe button so you don't miss future trading tutorials. Thanks for watching, and I'll see you in the next one.